From the morning reading, oil breaks above 50. Energy leads as the spider continues sideways day 22. Alcoa to report before the open. 9 of 10 sectors moved higher and one was unchanged on Monday. XLE, XLU, and XLK were the strongest sectors while XLP was the weakest sector. Oil futures reversed Friday's pullback and rose $1.61 to close at 51.16. Breadth strengthened compared to the prior session as advancers led 2158 to 845 on the New York Stock Exchange and led 1959 to 832 on the NASDAQ. Everything has rallied this year. As noted in a Monday article in the Wall Street Journal, the major markets, stocks, bonds, oil, and gold have all rallied so far in 2016. If we go back to 1983 and look for other years when all four markets showed a positive return through September, then the fourth quarter showed consistent gains in stocks and especially gold, with weakness in bonds and oil. Option traders have returned to bullish strategies. Looking at data across all U.S. exchanges last week, data that showed that the traders focused on bullish strategies 20% more than bearish ones, the most since July of 2015. When this spread has been this wide over the past decade, the S&P 500's next week returns were an annualized negative 8.3%. Utilities have really been hit. If no utility stocks close above their 50-day moving average on Monday, it will mark the fifth straight day. Since 2000, only 36 days have seen such a prolonged streak with no stocks trading above their medium-term average. Over the next 30 days, the XLU fund showed a positive return 32 times for an 89% success rate. It averaged a gain of 6.1% at its best point versus negative 3.8% at its worst point, with the only real failure being in February of 2008. Even if there's a major trend change going on in safety stocks like utilities, the selling has reached a point that is unusually severe. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:31 a.m. Mountain Time, and I'm recording this in preparation for the market day of October the 11th, 2016. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's go ahead and dive into our morning report. At the time of this cut, things were a bit negative across all four of the U.S. broad-based indices, with the S&P futures down about 1/3%, Russell futures down about 1/4%, NASDAQ down just below scratch, and Dow down about 1/4%. Crude oil was down about 2/3%, Euro was down about 0.5%, bonds down just below scratch, and gold down about 1/3%. In overseas action, China was up about 0.5%, Hong Kong down about 1.25%, Japan up about 1%, Germany up about 0.5%, and the United Kingdom up about 1/3%. And macroeconomic reports for today of note for the United States, there's nothing. In terms of looking forward to tomorrow, we have quite a bit of activity by FOMC members. We've got Dudley speaking, George speaking. We also have the JOLTS job openings, 10-year bond, FOMC minute meetings, and I should say FOMC meeting minutes. That's the proper way to say that. And that's about it. So things do heat up a bit more tomorrow. In terms of current volatility, things are still very, very benign. Short-term VIX at 10.81, skew benign at a below 125. IV percentiles in the S&P at a 20. The Russell all the way down into single digits now at a 2. NASDAQ an 18 and Dow a 22. 3 of the 4 indices again yesterday repeated with no standard deviation size moves on a close-to-close basis, though the Russell did put in a positive one standard deviation move, basically reversing what had happened the day before. And let's go ahead and go to the charts. And yesterday's action was interesting in a couple of things. First of all, we kind of poked our head above this apex of the symmetrical triangle that we've been watching. Though it's starting to look like that whole triangle thing just should be voided. I'll wait another day or two just to kind of see how this sets up. But as we talked about repeatedly in recent days, the whole thing is extremely neutral, very finely balanced. So yesterday you get this little head poke and everybody seems to be looking good and markets are all up and lots of green on your board. And yet, this morning we're right back where we started from with yesterday's action. So it seems to be that we're still in this sideways market, and yesterday's action, while technically closed above this triangle for the first time in some 3 weeks of trading action, still did not actually achieve anything, in that it didn't break above this horizontal resistance, and that would seem to be now at this point more important than the triangle. The triangle itself doesn't seem to be actually ruling much action this far in. We were concerned about that when we started seeing it get so close to the apex. Same thing going on over here in the Dow. Dow did have, an action which certainly broke above many of the previous days' action, and yet this morning, has basically nullified all of that. NASDAQ even put in a new 52-week high yesterday, and while it has given back some, it certainly hasn't been giving back as much thus far as the other two indices that we just looked at. So we continue to see that the NASDAQ is the most bullish of the four. And then the Russell, also big day yesterday in terms of big green candle, but still, came to an end right where it mattered most, right up against this overhead resistance. Giving back some, so again, more bullish than the NASDAQ. Excuse me, I should say more bullish than the S&P futures and the Dow, perhaps a notch less than the NASDAQ. And then on crude oil, again, another one with overhead resistance. And look how it came right up and kissed right to the moment the previous 52-week high, and then backed off from there, and so far today has been basically in matter of indecision as to what to do from here. So you have this nice move, went right through the prior swing high, chattered there, resistance became support, came up as we expected and discussed right up to the 52-week high, but is having a bit of a struggle at that point. And then gold. Gold, of course, has had this epic failure and broken down hard and started to consolidate. We'll see if it can make the turn that we've discussed. And then bonds. Bonds, of course, have been decidedly weak and have broken down now but below the prior swing low. So we definitely have a new swing low on bonds. And really you have to start saying that the intermediate term for bonds has changed. We spent so many months with the intermediate and long term on bonds being bullish. Well, now we've got a whole series of lower highs, lower lows, and this is continuing to repeat at this point. So this doesn't seem to say anything about equities rolling over anytime soon. And perhaps this is a market that is a bit more clearer and trend than is the U.S. broad-based indices, which have been largely sideways for several weeks. And then the VIX. The VIX, basically just chattering down here at relatively low, commonly bull market kind of areas. Right now we're playing around less than a 14. Anything 12 to 15 is basically the land of the bulls. And nothing in particularly exciting or interesting really in that chart. Just very low and quite neutral. So that should be enough on the charts. Not an awful lot of excitement there in the charts today, and that certainly has been our story now for going on 3 weeks. We still have this up against resistance character by several of the markets, and certainly we're calling this market phase 4. In terms of market timing signals, the first one from IBD confirmed uptrend, still in place. GMI index went to a perfect 6 out of 6 and 8 out of 8 yesterday, and the buy signal is still in place since 9/22. And the decision point scoreboard from stock charts, we saw quite a bit of flipping back up. This has been flipping back and forth, a lot of chatter. What might be different about this is that we're starting to see a bit more consistency in the time frames, and certainly in the short to intermediate term on both the S&P 100 and 500, we've got finally alignment. Also, the Dow, this one's been so weak of late, and now we have short term on both sides of the models showing bullish signals. So we'll see if we can get the intermediate term to flip on that one, and the NASDAQ to come in alignment, and that would be certainly more consistent than we have seen in quite some time. Of course, this is all up against the backdrop of the long term and all of these being mixed signals. So not much change from yesterday, perhaps a bit more of a bullish bias and a little bit more consistency coming from the decision point scoreboard, but still up against an awful lot of overhead resistance and up against these signals that are not stacked and clean. The position sizing opinions, both models still coming in 100%. Intermediate term market posture has flipped again, and right now is on a strong bull signal with the supportive bullish sentiment line. And you see here just above 50, 54.5 on the S&P with an upward slope after yesterday's action. So they're all bullish at this point, but this is first day, and these have been flipping back and forth. I think we still take this as generally intermediate term neutral, finely balanced, with a slight nod to the bull side. Hedge warning status will remain at 0+, and frankly, we remained at 0+ through all the chatter that we have had in the last 3 weeks. And this, of course, means normal with some cautionary aspects. In terms of the strategy opinions, no change from yesterday. We continue to be inside the acceptable windows to trade option income strategies as well as cover calls and put selling, though we have a relatively defensive structure on cover calls. Remember, while we have this slightly bullish bias, we've not actually moved anywhere of any great significance. And so if you're making money off of cover calls, it's probably because of the premium that's sold more so than that the actual underlying stock has appreciated. So using this 2-to-1 ratio of in the money, out of the money strikes would certainly give you a structure that is in alignment with current market postures. In terms of specific warning areas, we did have the volatility ratio warning kind of closed back within the area. So that one's a new one. I'm not sure in the context of everything else what to make of that one right now. So we just have these two warnings, that one plus the high distribution day count on the S&P. So everything else fairly benign, trend-based, benign. In fact, we even had a strong bull signal with 365 on the New York Stock Exchange new high, new low indicator. Intermarket risk aversion indicators all are in position for risk on. Sentiment, all relatively benign. In fact, the fear and greed index is still stuck on just about a perfect neutral setting. In terms of the sector specific, you can see pretty much a sea of green here with some weakness coming in industrials and consumer staples, but as an overall sector, they did eke out a positive day. Probably the most interesting thing here is look at utilities. Been beaten down so many days in a row, and every single utility was positive yesterday. And without the big move in crude oil, would have been the most positive sector of them all. So big reversal there in utilities. And in terms of our market postures by sector, a lot of Christmas tree lights here. And again, a lot of these have been just kind of wrapped around themselves. So until we actually see some consistency and some real trending, hard to make too much of this other than to look for areas of consistency. And perhaps energy, technology are probably the most consistent ones in terms of the bullish side. And one day you see energy, utilities up very strongly yesterday and falling back from there, but everybody in the green. So that should be enough for today. Let's go ahead and wrap this thing up and get it to publishing. We will go ahead and hit the disclaimers. Disclaimers, as always, hit the pause button if you need more time to review the disclaimers. Also note down here at the bottom the hyperlink with the full set of disclosures. Be back here tomorrow for the next market preview from Falcon Global. In the meantime, manage your risk and go learn something.